Hello and welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. If you have a question about shares, our phone lines are open and the number to call is 1300 30 34 35, or you can always email us on yourmoney@skynews.com.au. And joining me on the panel tonight, we are very lucky to have Ben Clark from TMS Capital and also Nathan Bell from Intelligent Investor. Earnings season almost coming to a close, and what a session it was today with some massive moves. We saw QB Insurance jumping, BHP Billiton doing well. So let's find out from our panellists what they make of earnings season and if they've changed their investing strategy for the rest of the year, given the success that we've seen so far. Ben, what do you think?
It's been a tricky time. I mean, what's been interesting is from what I've seen, a lot of companies have come in pretty close to their guidance and given outlook statements which haven't really sort of surprised me too much, but the share price reaction to a lot of those results has been amazing to see. I mean, we've seen a lot of the better quality stocks, it feels like to me, ran quite hard into their results, and there was these really vicious sell-offs on the first couple of days, and they, in hindsight, has been some really good opportunities to purchase stock. And a lot of the underperformers have had some really big share price moves higher, and I think, you know, particularly in places like retail, I think we've seen some really aggressive short covering occurring. I think we saw that as well today in a stock like Flight Centre and also in QBE. So it's been very volatile, but that volatility has created some great opportunities over the last few weeks. So, you know, maybe we'll talk about some of those tonight. But
we'll talk about some of those opportunities that have come up. Nathan, what do you make of earnings season so far?
I feel like the same trends are probably still in place. Any company that's growing by any decent amount or is seen as reliable or is benefiting from low interest rates, so anything in the A-REIT sector, for example, all those companies are doing okay. And then on the other hand, you've got some economically sensitive businesses where they might have actually enjoyed a bit of a stock price rise because people have thought actually it's not quite as bad as what we were thinking, like the reject shop is one. But still, if you look at Trans-Pacific, you know, affected by the oil price and the slowing economy, these sort of companies are still hurting. But that's actually where we're trying to look, because I think there's going to be some cheap stocks in that area as opposed to paying 25 times earnings for Cochlear or CSL or what have you.
Okay, so it sounds like it's going to be an absolutely big show. Lots of companies to talk about. We do have our first caller on the line, so let's go straight to Nick from Melbourne. Nick, welcome to the show. What's your question for our panel tonight?
Hi there. I just had a question about MyNetPhone, MNF, and also ComputerShare. The first one, MyNetPhone's a fair way off the year's high, and reported with pretty small organic growth, but basically making a number of small acquisitions. And also just about ComputerShare, seemingly all this new M&A and sort of exchange rate has not really seen them outperform that I thought they might have. If you could just help me with those two, thanks.
Okay, sure. Let's start off with MyNetPhone. Very interesting company because it did go ex-dividend today, 2.5 cents, but its stock fell a lot more than that. In fact, the stock down a massive 14 cents today despite going ex-dividend 2.5 cents. So that's a pretty big move down by MyNetPhone. And in fact, over the past month, we've seen it down 17.5%, whereas the rest of the market has managed a nice rise of 7.7%. So, Nathan, just looking at MyNetPhone, what are your thoughts?
Yeah, I actually don't know anything about this company whatsoever, so I'm going to defer that to Ben and focus on ComputerShare, or we can do
Let's go with ComputerShare.
So the real problem with ComputerShare, and we've actually done pretty well out of this stock, but what we underestimated was just what the impact of low interest rates has on that business. So if you think about the company, what it does is it charges what are relatively small amounts to hold a lot of cash on behalf of companies and shareholders. So in a takeover, for example, if there's money to change hands, ComputerShare sorts out all the paperwork and it holds the money for a certain period, and that's been a really nice source of profit over the years. But the M&A activity has actually increased. The problem is when the actual M&A is done, again, we underestimated just how much money was made just from holding the cash in those transactions. So a lot of things have gone right for ComputerShare. They got all the cost savings out of the big acquisition in the US. It's benefited from the fall in the Aussie dollar, and the business is profitable. But again, it just needs higher interest rates, particularly in the US and Canada, for the earnings to really take off.
Okay, so computer share really hurting from the lower interest rates that we've been seeing, which forms part of its profit. Looking at my net phone, what are your thoughts, Ben?
Yeah, well, it's an interesting little business. It's almost like a disruptor to the telcos, to like the mid-cap telcos, because it's got a product offering which appeals to sort of small and mid-cap businesses, and it's been quite successful in rolling that out. The thing I'd say, Julia, is I'd say across the telco space was it just got way too far ahead of itself. A lot of these stocks, like I think my net phone was trading on a PE in the 20s, and it's just, you know, it's just too expensive. And the company has come out and actually met guidance, and this is what I was talking about at the start of the show. They met their guidance, and I think the outlook was actually pretty good. Yet the share price fell, and I think that was just the market looking at thinking, you know, it's too expensive. So. You know, I think it'll probably settle down at some stage. We're not in the business, and you know, it's been an interesting space because IONET had quite a poor result. MTU, I thought, had a good result, and TPG's not in this earnings season. Telstra's result was good, so it's been a bit mixed despite how strong that whole sector's run. You know, if I was in my net phone, I'd probably stay with it, but again, I just go back to comments we made in the past in the show that it was very expensive.
Okay, so it was very expensive. Come back down a little bit down to earth. Trading ex-dividend today as well, but we have seen a number of the telcos really giving up some of those strong gains. My net phone down by 8.2% in the past week, and the other one is IINet, which is down 13.5%. Let's go to our next caller. We have Brett on the line from Sydney. Brett, welcome to the show. What's your question tonight?
Oh, hi. Mine's regarding IINet, actually.
Sure.
I've noticed it had a really big pullback. And I'm just wondering at these levels, do you think it's fair value? And also another one I've been tipped, maybe you know something about, it's called Empire, ticker EPD.
Sure.
And that's it. Thanks.
Okay, so let's start off with IINet. Massive fall. I mean, a few months ago, this stock was trading at $8.40. It's dropped down closer to the $6 level now. $6.17 is where it finished up today. We have seen that earnings result coming through. I noticed that Morgan Stanley's turned bearish on IINet, saying that it's being outflanked by its competitors at the moment, which means market share losses in broadband and phone services. Ben, what do you think?
I wouldn't be buying it now, but I do think there's an opportunity getting close here. I think the result had some pretty nasty news on the cost side, but it was sort of weird because the management have forecast that they'd have to ramp up costs during the half to provide high levels of service. But they only got 25,000 new sort of customers onto their offering. They're now nearly number 2 on ADSL. But, you know, because they haven't been on the acquisition trail so much during the last couple of years, I think they've got a lot out of what they acquired, and it's the organic growth isn't enough to warrant where the share price was trading. So, you know, like I tend to think it's a good quality business. Got a new CEO in there. I think transparency with the market could have been better leading into this result. You know, Michael Malone's left to the founder and the CEO who did such a great job. And, you know, I just think it might sort of be on the sidelines for a while, but I think potentially there could be an opportunity, but I wouldn't go yet, Brett.
Okay, so you'd be waiting. Looking at IINet, Nathan, what are your thoughts?
Yeah, the sector, if you look at it over the last 5 or 10 years, it's been absolutely remarkable how these share prices have performed. So if I saw any weakness in any of these telecommunications stocks, I wouldn't necessarily be thinking anything's broken or wrong. It's just that the valuations have been so high that there's no room for error. The one we focused on was M2. It was very acquisitive. It's ripped out a bunch of costs, and it sounds like it's suffering from the same problems that IINet is, and that is that there's actually not that many more customers out there to chase. The industry itself has consolidated enormously over the past 10 years, so there's only so many more marginal customers you can pick up, and they tend to be fairly expensive because the only companies left to acquire are actually quite small. So IINet's on our watch list, but it's not a buy for us yet.
Okay, and the other one is a small company called Empire, and I guess it is an environment where it is difficult to find high growth, but it looks like Empire is looking at 100% earnings growth and on a pretty good growth trajectory. It's been making some good acquisitions there, which I guess would impact negatively in the current financial year, but in FY16, FY17, they should really start to kick in. So looking at the IT space, any thoughts on this one, Ben?
I've never heard of it, I'm afraid, Julia. I'll have a look at it when I get a chance after this week, and yeah, see what I think.
Nathan, in the IT consulting space, applications, share price has been going absolutely nuts, 72.5 cents. So it looks like it is going to test that all-time high that we've seen at 83 cents last November.
I'm not familiar with the company, but it is an interesting space, and we put a mini portfolio together a year or year and a half ago. And what we've seen in the results of those companies, for those, I guess what we call them small caps in the IT sector, is the range of earnings performance from these businesses has been just completely disparate. SMS is one company that's done okay, and we've got good share price rise. We look at something like DWS, and the share price took off, and now it's back to where it started. The problem with these companies is they're a bit like the mining and engineering contracting businesses. It's often very hard to know what sort of work they're working on, how long it's going to last, how stable are their revenues, who their main customers are. And often you find with these companies is they do get very acquisitive because they've got no natural growth in their business, and the only way they can grow earnings is to go and buy other customers. And you never know how long that work's going to last anyway, or how the relationships will be with the new company. So it's a space that you need to be very careful in, but I don't know much about Empire.
Actually, this is a stock I mentioned on Switzer two weeks ago, so it's good to see that it's doing well. I mean, a lot of their large contracts are with a higher margin areas like energy, natural resources and infrastructure projects as well. I think the biggest client, which accounts for about 12% of revenue, is Main Roads, so that's Victoria Main Roads, actually Western Australia Main Roads, so good to see that it is doing well. On that note, we will be back with more after this short break. If you'd like to speak with our expert panel, please give us a call on 1300 30 34 35, or you can email us at yourmoney@skynews.com.au.
With summer holidays comes lots of outdoors time. Keep Stingo's gel or spray handy for fast relief from stings and bites. Take the sting and itch out of summer with Stingo's.
Dad?
Yes?
You got grabbed by a
Pterodactyl?
Yeah, and then got dropped.
Yeah.
And stomped on by a big herd of these. And eaten up by a big T-Rex. Who'll look after us?
None of us can see what's coming, but we can help protect those that matter most with award-winning life insurance from Allianz.
Try playing with this.
Allianz Life Insurance, because it matters.
Good day. Welcome to Hello. Unlimited broadband, no lock-in contracts from $48 a month. That's unlimited broadband, no lock-in contracts from $48 a month. Call us or visit hello.com.au. Terms and conditions apply.
You know when you've met the one. Your heart beats faster, yet time stands still. Everything old seems new again. It seduces your senses, stirs your soul. It's in your DNA, like you finally found your chosen path. Are you ready to meet the one?
You're my kill of the night.
Smart knows it's hard saying no to that fifth piece of irresistible chocolate. Simple is getting the strength you need at the touch of a button. Enjoy the benefits of Smart Made Simple with new live online coaching from Weight Watchers.
Anton's Animal Kingdom.
Anton!
How may I help you?
Help!
Be quiet. Silence.
If only everything was as easy as creating your website with Wix. Go to Wix.com today. It's free.
Hotels Combined quickly compares hundreds of hotel booking sites and combines them into one simple search. So finding the best deal is easy. Save on your hotel at Hotels Combined or download our free app today.
Miss Clark, your driver is here. Shall I get him to wait? Miss Clark.
Officeworks has everything for big thinking small businesses. So whatever your big ideas, Officeworks has the lowest prices.
I just want to find the perfect hotel for us. And I want to book it for the best price. Hotel Trivago.
Welcome back to the shares edition of Your Money, Your Call. We are still taking your calls on 1300 30 34 35, and you can email in on yourmoney@skynews.com.au. And we have Greg on the line from Adelaide. Greg, welcome to the program. What's your question tonight?
Oh, thank you. I'm ringing about Toll Holdings, which I'm already a holder of some shares. I'd like to know whether I should be looking at selling them now, waiting for the dividend, or waiting for the $9.02 later on. And have your panellists got an idea of what could be the next Toll holding?
Sure. I mean, great position to be in. Of a massive jump in share price. Have we seen all we're pretty much going to see in terms of that jump? Would you tell Greg to be holding on at this point or selling shares? What do you think?
Sell, and I wouldn't even think about, I mean, we sold out in the first morning that it came out. I could not believe the premium that has been offered. I mean, you never see that. Hardly a 50% premium on the first bid. The directors, I think, accepted it so quickly that, you know, like, we're struggling to keep up. I mean, it's like a kamikaze bid, you know, it's so crazy. So normally there's argy-bargy on price, and, you know, your first price is never your last price, but I would be out of there, because if the deal falls through, it's going straight back to $6.
Absolutely.
So, you know, there's a little bit of upside left. There's also an opportunity cost. You could be in something else now, which is going to go up a lot more than Toll is going to go from here.
Okay, so Ben would be selling straight away. How about you, Nathan?
Ditto. I have nothing to add. Toll's a pretty tough business. It always has been pretty capital intensive and pretty low margin, and really struggling for growth over the last 4 or 5 years. So it's not the greatest business in the world, and if you get an offer like this, you just take it.
Okay, so take it and run. Toll Holdings, great position to be in for Greg from Adelaide. Let's go to our next caller. We've got Bernard on the line from Brisbane. Bernard, welcome to the show. What's your question tonight?
Yes, thanks, Julia and panel. I rang probably about a year ago, probably give or take a week, in regards to CSR. I think it was in the low 2s, maybe in the early 3s. It's over 4 now. I'm still in it, still trading it and making $1. Would you be in it or getting out?
Beautiful. I mean, great run up for CSR. And I guess all those building material companies have been doing fairly well on the back of that boom that we've seen in construction, and certainly CSR has been doing extremely well. Its last traded price at $4.34. Deutsche Bank, though, upgrading CSR from a hold to a buy, even though we've had this massive run up. I mean, Nathan, looking at CSR, would you still be buying at these levels?
I have to say we've probably missed all these building construction type stocks, even though there's some better quality businesses in there, I think, than what they look sometimes. Adelaide Cement or Adelaide Brighton is one of them. I'm not sure what the right thing to do now is, because we just haven't kept a close eye on it, because it just doesn't hit our quality filters. And for us, we've had an overall strategy of trying to steer clear of anything or most things that rely on a strong Australian economy. Our view has been that the Australian economy is slowing. That's not to say the banks can't still make money, but a lot of these other businesses we've seen, as I said, Trans-Pacific earlier, you know, has really been hurt by lower profits and the oil price, and I think the economy is going to continue to slow, so I'd be quite careful about these particular companies.
Okay, so Nathan, a little bit cautious about the building material companies. I mean, CSR, they've got that tie-up with Boral, the whole East Coast, the brick making, some talk that the synergies are probably going to be bigger than what the companies have come out to say, which I think is about $7 to $10 million, and that we could see some of the land being liberated, because, of course, they don't need all of the operations they currently have separately if they're going to combine. Ben, but would you be buying at these levels?
I wouldn't be buying, Julia. We have been in CSR, and we got out sort of too early in hindsight, but this business is, you've got to be careful with, because I think of all the building stocks, except maybe James Hardie, it has the most operating leverage on its balance sheet to the good times, but also to the bad times. So the share price has run very hard, because we're experiencing very good times in building at the moment, and they're probably going to keep going, I reckon, for another couple of years, particularly on the East Coast. A lot of resi development is locked in, but the market will look 12 to 18 months ahead, and when there are signs, you know, as Nathan was saying then, that things are going to start slowing down, these share prices will slow a lot faster than the sector. So I'd be getting pretty tempted to take a profit. The one we own in the sector and have for several years now that we do really like is Dulux, which you know, is the largest sort of paint manufacturer and distributor in Australia, and you know, it's got very high return on equity. But we like it because in the bad sort of construction markets, people continue to paint. It's something you need to do every 5 to 10 years, and it accelerates in the good periods. But it's very well managed. It's got a great balance sheet, and you know, it's got a dominant sort of position. So that's the one for us in the space.
Okay, so CSR, like many companies, is very much a cyclical business, and Ben's saying watch out when the cycle turns, or even before the cycle turns, because the share prices usually fall pretty hard then. Let's go to our next caller. We have Mark on the line from the Sunshine Coast. Mark, welcome to the show. What's your question tonight?
Hi, Julian. Good to hear your voice. Haven't talked to you for a while. And gentlemen, API is my first part of my question. I bought it at 57 cents. It's $1.10.
Beautiful.
Pharmaceutical company. I'm just wondering, is there any more run in it? Is it worth keeping for a while? Because I've had it for quite a while. And if anyone doesn't know about that, AMP is the same. I bought that for $6 years ago. It's been down now. It's taken off. I don't know why. And is it worth keeping also?
Sure. So having a look at Australian pharmaceutical industries and AMP. I mean, API doing extremely well, buying in at 57 cents, and the stock last traded at $1.10. So Mark doing extremely well. You probably know Australian pharmaceutical industries because it owns Priceline, and we've just seen the company coming out to upgrade its outlook with a 20 to 25% higher outlook for its first half net profit. Ben, what do you make of this one?
Look, I haven't looked at it for a while, Julia. I mean, I know that they're in a sort of almost a roll-up where they're, you know, chemists are effectively selling to the Priceline brand, getting sort of earn-outs, and they're getting a lot of help with their back end in terms of dropping costs and marketing help. Seems to be onto a winning formula. I think pharmacy generally is quite a tough game to make money in, and it's getting much more competitive with Chemist Warehouse, you know, I think is doing very well, which isn't listed. And, you know, the supermarkets continuing to try and nudge their ways into that sector. So, I don't know, I'd be a bit careful on it. AMP, I thought the result was good, and it's mainly been driven by the wealth division, you know, financial planning and funds management, which it should be given, you know, what's going on in the share market and in the superannuation industry at the moment. It's still not a stock we would have sort of buy. I mean, our view is that if you really like the insurance side of AMP, go for a well-managed insurer like IAG or QBE or Suncorp. And if you really like the wealth division, we think there's better sort of pure play options than AMP. So it's not for us.
Okay, and Nathan, looking at API, I noticed Macquarie and Bell Potter, they both have a buy on the stock, but we've seen Deutsche Bank downgrading to a hold for Australian pharmaceutical industries. What's your thoughts?
Yeah, I don't really have anything to add on API. Retail is tough at the best of times, and God help them if ever Woolworths or someone else got into that space a bit more, because they're the last guys I'd want to be competing against. In regards to AMP, ever since I've been in the stock market, I've really had something against this stock. It just seems like such an outdated business model. It's very high cost. It employs so many planners, and it's all based on this big brand, but I think it has somewhat of what I might call an intergenerational brand value. It's very well recognised to, I think, retirees and the baby boomers. I don't think it's anywhere near as relevant as what to the next generations, and I don't think the younger generations will ever feel that they need to go to AMP for any of their services, particularly with what we're seeing with financial planners at Commonwealth Bank and now National Australia Bank. So I think there's some headwinds there that may not be headwinds in the next 1 or 2 years, but I feel like over the next 5 or 10 years, this isn't a stock that you really want to own. And I'd also echo what Ben said, is we much prefer the good fund managers, whether it's a platinum or a perpetual.
Okay, so that was API and AMP, both stocks that have been doing quite well recently. We will be back with more after this short break, but if you'd like to speak with our expert panel, please give us a call on 1300 30 34 35, or you can email us at yourmoney@skynews.com.au.
At Nissan, we wanted to create Australia's largest SUV range to meet the needs of even more Australians. So we did. The end.
It's the big one at Nissan. Get 1% finance on popular SUV models.
Officeworks has everything for big thinking small businesses. So whatever your big ideas, Officeworks has the lowest prices.
In the race for an investment property, a free ANZ Property Profile Report is packed with useful information, like rental yields and recent sales results.
We'd like to make an offer.
You don't need to be an ANZ customer. Just search ANZ Buy Ready.
Where to next? I'm the king of the world. Ooh, what's that? Now you're talking.
Whiskers helps nurture your cat's inquisitive nature, providing everything they need now and at every stage of their life.
If I told you there's an issue that costs Australian business $10.9 billion every year and likely affects 1 in 5 of your people, wouldn't you want to uncover it? And if you knew that every dollar invested in addressing it returned $2.30, could you ignore it? Make your people happier and more productive. Go to headsup.org.au.
Creating my stunning website with Wix is really easy.
Anton's Animal Kingdom.
If only everything in business was as easy as Wix. Go to Wix.com and create your stunning website today. It's free.
Smart knows that short bursts of activity can be just as effective as long, tedious workouts. Simple is finding 4 minutes with our new innovative exercise plans. Enjoy the benefits of Smart Made Simple with the new Weight Watchers.
Dad?
Yes?
You got grabbed by a
Pterodactyl?
Yeah, and then got dropped.
Yeah.
And stomped on by a big herd of these. And eaten up by a big T-Rex. Who would look after us?
None of us can see what's coming, but we can help protect those that matter most with award-winning life insurance from Allianz.
Try playing with this.
Allianz Life Insurance, because it matters.
You know when you've met the one. Your heart beats faster. Yet time stands still. Everything old seems new again. It seduces your senses, stirs your soul. It's in your DNA, like you finally found your chosen path. Are you ready to meet the one?
You're my kill of the night.
Welcome back to the program. I'm Julia Lee from Bell Direct, and joining me on the panel tonight we have Ben Clark from TMS Capital and Nathan Bell from Intelligent Investor. So if you have a question you'd like answered, please give us a call on 1300 30 34 35, or you can email yourmoney@skynews.com.au. And we have Robert on the line from Victoria. Robert, welcome to the program. What's your question tonight?
Yeah, hi Julia. I've got a couple of questions. The first one is on BGL. I just want to know the panel's thoughts on that one.
Mm-hmm.
And also on valuing stocks. Can you use the PE ratio compared to the historical PE ratio of that company to value a stock? Thanks.
So you're talking about the forward-looking PE ratio compared to the historical?
Yeah, or just the PE for that point in time, the TTM one.
Sure. So the trailing PE ratio. Okay, let's talk about Big Air first. BGL's the stock code there. We have seen the stock price falling quite severely since the first half numbers. It looks like they came in below expectations, and we saw some weakness in a couple of core businesses. Morgan's saying that, you know, the weakness is an opportunity to buy Big Air. So once again in that telco space, Nathan, what do you make of this one?
We saw a presentation from Big Air a couple of years ago, and I just thought quite simply that there was a high chance that the business model wouldn't even work in 5 or 10 years as new technology eclipsed it. This is a very fast-moving space, and if this company is trying to knock up acquisitions and you know, get synergies already for such a, you know, given it's had this core offering for students and whatnot, and if the growth is already going from that business, I'd be surprised if this business is still around in 10 years' time. It's just a really tough business, and again, very fast-moving. I'd much prefer the bigger, safer companies in that space.
Okay, so preferring the larger telcos. How about you, Ben?
Oh, look, I haven't really looked at it. I've got to say, Julia, I mean, I know they're sort of, they operate software wireless, it's wireless networks, isn't it? Yeah, I guess, you know, you would say they're always at risk of someone coming along who's much bigger doing it a lot better. But, you know, look, I haven't looked at the financials. You know, one thing I would say again is that share price chart we're seeing there doesn't do justice to what that company's share price has done over the last 3 to 5 years, where it's had an incredible run. And, you know, it's the same formula, isn't it? Sort of probably trading on a fairly high earnings multiple, high expectations coming to the result. They only slightly miss, but that's all it takes given those circumstances. And it's why you've always got to keep reviewing what you do own coming in, particularly coming to earnings season. Small cap stocks trading on 23, 25 times earnings, you've got to be pretty confident that the result's going to be really good.
Okay, and I guess the other part of the question was around PE ratios and how you use them in terms of valuations. There's so many, the historical, the trailing, the forward-looking ones. So just in terms of PE ratios, do you use them at all, Ben?
Yeah, we do. I mean, one thing retail clients I think always struggle to get their head around, because you see people on the show, in the paper, analysts say with such authority that a stock is worth X, but it's actually impossible to value a company because you have to make so many assumptions as to, you know, what their future cash flows are going to be over a number of years, what the discount rate that you use to bring those cash flows back to current year earnings. Everyone uses different numbers, different assumptions, and therefore, you know, there is no one perfect way of valuing a stock. I think an earnings PE multiple is useful, and particularly what the caller was saying there was sort of looking at companies like, if you look at the banks at the moment, they historically have traded on PE levels of around sort of 11 to 12 times earnings over the last 20 years. Commonwealth Bank is trading on 16.5 times its next year's earnings. By any measure, it's expensive, but we all know why it's expensive, because the yield's good, it's seen as safe, etc., etc. So it's a good guide, but it doesn't necessarily mean, you know, when it was at 14 times, you would have said the same thing, but it's gone up another 15, 20% since then. So it is something to keep an eye on, but it's not the only thing to keep an eye on.
Okay, and Nathan?
When we have young analysts come into Intelligent Investor, one of the biggest things they struggle with is what's the right price to earnings ratio for this business? And my response, and sounds a bit facetious, but if you're asking that question, it's generally because you don't understand the business well enough. It's actually, can take a week or 2 weeks sometimes to really understand a business properly. And if you understand what drives it and what the outlook looks like and all the things that affect its earnings and dividends 5 and 10 years hence, then you can actually get a feel for what the right price is to pay for a business. Until you've done all that work, which is what we spend all our days doing, it's very hard to come up with a valuation. And it doesn't matter which valuation method you use, whether it's book value, PEs, enterprise values to operating profits. It all comes down to your understanding of the business. And I guarantee you, if you spend 2 weeks getting to know everything about a business, you will have a very good idea of what the right price is to pay.
Okay, so a good question coming through from Robert. Robert, I always think of it when I go shopping, I can use price to work out whether something's cheap or expensive. But when it comes to the share market, it makes no sense to compare an $8 stock to a $1 stock. So you use PE ratios instead. And a high PE ratio, I guess, just tells you that the stock's expensive, that you're paying a premium now, which is absolutely fine. It's just that if you're paying a premium now, what do you want in the future? And the response is usually a higher return or higher growth rate. So those high PE ratio stocks, you're probably paying for higher expected growth, so you want that growth to come about. Whereas the lower PE ratio stocks, they're relatively cheap, so you're probably expecting some lower growth to come through. So I usually think about it in terms of shopping, if that helps.
Very good.
Let's go to our next caller. We've got Andrew on the line from Melbourne. Andrew, welcome to the show. What's your question tonight?
Hey guys, I'm actually ringing on behalf of my fiancée who was too shy to call in, but she's sitting here next to me watching.
Very good.
She bought a stock about 3 or 4 years ago, Fisher & Paykel Healthcare, FPH, who is involved in sleep apnea technology, I believe. It's had an amazing run, just seems like it will never stop going up. And given that it's had such a good run, obviously technically it still looks good, but she wants to sort of know at this new substantially higher price if it still represents value fundamentally.
Congratulations to your fiancée. You're marrying a very smart woman, because this share price chart, if we can bring it up, looks absolutely amazing. 5 years ago, the stock was just above the $2 mark. We're seeing it now at $6.32. So it's had a fantastic run. But I guess the question that Andrew is asking is whether this can continue. So Ben, looking at Fisher & Paykel, what do you think?
Yeah, look, we've got a small amount of the company ourselves, and yes, Julia, I think it can continue. I mean, look, Andrew, what I'd say to your fiancé is the stock doesn't look cheap. However, they are growing earnings at quite a rapid rate, and most importantly, the industry they're operating in continues to grow at a rapid rate, and I think will continue to grow at a rapid rate in the future. There's three main players in this industry who are ResMed, which is the dinosaur, and then you've got Respironics, which is owned by Philips, and Fisher & Paykel Healthcare. And Fisher & Paykel were the smallest player, but the smallest player can often grow the fastest because they can carve out a niche for themselves that maybe the bigger two players either aren't doing well enough, or it's easier to grow off a lower base. And they proved to be very effective at it. We really like this sort of the industry. They reckon that sort of 1 in 3 people has sleep apnea, but the actual rate of diagnosis is very, very low. There's this big trial in the US at the moment, which is being run by ResMed, which is looking at the link between sleep apnea and having a second heart attack or sort of heart failure.
Wow.
It's going to be released in about a year, and that could be a game changer for this industry, where if they can prove that people who suffer from sleep apnea are much more likely to have a heart attack, then doctors are going to have to be more on the front foot in terms of diagnosing it and treating it. And all three players will win. So personally, I'd stick with it.
Okay, so staying with it. Nathan, what do you think?
I just echo Ben's comments. We love the industry, love this company, and yet I stupidly sold it at $4 after we doubled our money and thought we were pretty clever. One of the other short-term things that's really running nicely for the business, aside from the wonderful operational performance, is that the currencies have all moved in its favour. The New Zealand's up against the Aussie dollar, I think, at a record, and also the US dollar's been much stronger, so that's great for this business, given most of its profits, revenues, but also a lot of its costs are overseas in Mexico now as well. So everything's running right for this business at the moment. What I would say is, if you find a great business like this that you're quite comfortable that's still going to be around printing money like this one does for the next 10 or 20 years, if you really are a genuine long-term owner of high-quality businesses, I'd be loath to let this go, despite the stupid decision that I made. We actually do prefer ResMed over Fisher & Paykel Healthcare at the moment, but it's more because ResMed's got $600 or $700 million worth of cash sitting on its balance sheet, and Ben said it's the dinosaur. It's also the biggest and is the gold standard. That's not to take anything away from Fisher & Paykel Healthcare. We just think at these multiples it's just a bit safer balance sheet wise.
So Andrew, fantastic work holding Fisher & Paykel, and it looks like both our panellists still liking that, so I hope that helps you and your fiancée out as well. Let's go to our next caller. We have Richard on the line from Sydney. Richard, welcome. What's your questions tonight?
Hi, Julia. Look, the question is basically 2 or 3 points. It's about infrastructure first off. I'm just watching the Switzer program. I mean, basically most of the infrastructure I see in all the companies I've invested in, Origin, Rio, BHP, they are supplying all the infrastructure, making bigger ports in the gas pipeline for Origin, I dare say Fortescue shareholders and Santos shareholders and Oil Search shareholders would agree. Where's the other infrastructure going to come from? Also, the main question is on car sales. How does Ben see that? I know he's a follower of the stock, and thanks very much. Thank you.
So talking about infrastructure and car sales. Let's start off with car sales, up 1.3% today, $10.30. It's just been consolidating, I guess, moving sideways throughout the last few months. What do you think, Ben?
I still like the company. I think what they sort of said in the result, Richard, there was a bit of disappointment from the analysts that levels of cost were higher in the business, and subsequently sort of there was lower margins. That was mainly due, I think, to the purchase of Stratton Finance, which is sort of flowing through to their books now. Look, with car sales, I think they still are a very good quality business. I have a little bit of a question mark in terms of this big international push that they're doing. I just feel like they're coming sort of much later to the party than, say, a Seek, and paying much higher prices for these businesses. And, my concern is that they really need to execute well and turn these businesses into very profitable operations to warrant the prices that they're paying. But look, I think for the moment, Julia, it's still a good stock to be in. It's paying a good dividend yield. Probably the most mature of the three. We own Seek, Car Sales and realestate.com. REA, I think, has the best near-term drivers. Seek, I think, has the best international business of the three and best management. And Car Sales, I think, is going through a period of heavier investment to drive future growth, and it just might sort of consolidate for a little while until it has that sort of next leg in its share price.
Okay. Nathan, any thoughts about car sales?
Car sales is actually on our buy list at the moment, but I'd say it's quite a marginal call. It hasn't really done a lot for us since we recommended it a couple of years ago, particularly if you compare that to SEEK or REA, which have done much better. Again, like Ben said, it's a high-quality business, and the one thing I do think it still has over a lot of other businesses, pricing power. The amount that a customer like you and I would pay to sell our car on the car sales website is still quite low compared to the actual value of the asset you're selling, unless you own a complete rust bucket. But it's a question of actually how much of that pricing power can they actually realise over time. Is there some sort of limit to where they can take prices before competition starts to impinge on the company? I don't see it happening in the short term, but we still like the business.
Okay, and the other question was around infrastructure stocks, and I guess this is an interesting one because, you know, as Nathan mentioned, those companies that are interest rate sensitive, and you could say infrastructure stocks, usually holding a large amount of debt, usually quite interest rate sensitive, especially as interest rates go down, it's a positive, not to mention, you know, the yield trade is still such an attractive one. What are your thoughts on infrastructure, Ben?
We own a large swag of sort of infrastructure stocks. The only thing I'd say there is the stocks he were listing would not be the stocks I'd be suggesting will do well from infrastructure spend. The Origins, the Fortescues, the Rios, the Oil Searchers, they're really going to be driven by the global growth story. I mean, ultimately, iron ore is set by the Chinese. It's not set by Australia building a few more roads or an extra airport or something like that. It's set by what the Chinese are doing, and the Chinese economy is slowing. You know, I personally think Rio is probably a sell at current share prices, and we're still quite bearish on sort of what's happening in the resource space. And gas prices, you know, it's really linked to oil, and that's a global sort of growth story. So we really like infrastructure stocks, albeit we're struggling to find any of them that are decent value at the moment because they've all had such great runs. But I would say to the caller that the stocks you were listing there were not stocks that I would be saying going to benefit from Australian infrastructure spend.
Okay, Nathan, infrastructure stocks?
Yeah, if we're actually talking about what I would consider infrastructure stocks like a Sydney Airport or the gas pipeline owners, all those sort of businesses, we were up to them in our eyeballs during the GFC because everyone just smashed the share prices because they were worried about the debt. And what ended up happening was, okay, a lot of them had to raise capital, but it didn't really matter. The earnings were still there and the actual value of the businesses was still there well after the capital raisings. The problem is we've actually been selling more of those than buying them. We've still got a big position in Sydney Airport. We just think that's I mean, a lot of these businesses are unique or monopolistic assets, which is why we like them. But Sydney Airport we think is quite special, so I'm reluctant to let it go. But in terms of the pipeline companies and some of these other businesses, they're affected by changing economics in the industries, things like solar, for example, which is becoming increasingly popular. This is actually going to have an impact at some point, or if not already, on companies like Spark Infrastructure that are gold-plating their network that we may not even need in 20 or 30 years' time. So I'd be very careful about paying current prices for them.
Okay, on that note, we are taking a short break, but we'll be back to answer more of your questions in just a moment. If you'd like to speak with our expert panel, now's the time to give us a call on 1300 30 34 35, or you can email yourmoney@skynews.com.au.
The strength of character. The power of presence. The sportiness of BMW Coupe. The assertiveness of BMW X. And the embodiment of luxury. The all-new BMW X6 has arrived. Power personified.
There are hundreds of sites to search and book a hotel. That's why there's Hotels Combined. With just one search, you can see all prices available, so finding the best deal is easy. Visit Hotels Combined or download our free app today.
Christine and Adrian, real everyday Apia customers. Do you think it's odd that when Christine called Apia, she got to talk to a real person and not a machine? Odd? It's not odd at all. Good service means taking the time for a chat 24/7 and not rushing you off the phone. Because the oddest things can happen at the oddest times. If you're over 50, call APIA for a chat today and find out how they reward your experience.
Come on, boys. Really, really cheap. Really, really cheap. Really, really cheap. Really, really cheap. Cheap, 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 cheap. From Monday to Sunday, all through the store, the finest and the freshest and so much more. And one thing's for certain, the word on the street, Woolworths prices are cheap, cheap, cheap. Lowest prices. Cheap, cheap, cheap. Are the nicest. Cheap. Come on down to Woolies where real low prices are found.
It's easy to create my beautiful website with Wix.
Let's go again.
If only everything in business was as easy as Wix. Go to Wix.com and create your stunning website today. It's free.
In the race for an investment property, a free ANZ Property Profile Report is packed with useful information, like rental yields and recent sales results.
We'd like to make an offer.
You don't need to be an ANZ customer. Just search ANZ Buy Ready.
You know when you've met the one. Your heart beats faster, yet time stands still. Everything old seems new again. It seduces your senses, stirs your soul. It's in your DNA, like you finally found your chosen path. Are you ready to meet the one?
You're my kill of the night.
On the next Rich Show, John Lyons, the journalist from The Australian. He comes back here for 1 month and blows up the Liberal government with a 2-hour interview with Peter Credlin. As well as that, Tim Pallas, Victorian Treasurer, and then Rebecca Wilson and drugs in sport. On the next Rich Show.
Welcome back to the show. If you have a question you'd like answered, please pick up the phone and give us a call on 1300 30 34 35, or you can also email us on yourmoney@skynews.com.au. And we now have Alan on the line from Adelaide. Alan, welcome to the show. What's your question tonight?
Thank you. My question's about Azalea Care, AHY.
Sure. So having a look at Azalea Care, this is a company that floated last year, mid-last year. It's been a little bit of a roller coaster ride. I think the IPO price was $1.65. As you can see, it hit a peak of $2.13 before trading around the $1.60 level throughout January and the start of February. But it looks like its latest result has beat prospectus forecast. So this is a company that looks at toilet paper. So you may know the brand Sorbent, tampons, Libra tampons, and they're expanding into incontinence products as well. Nathan, looking at this one, what do you think?
Yeah, there's two things I'd say. First is be careful of any business that's floated recently. We have a bit of a rule at Intelligent Investor that we generally wait 3 years for a company to be listed before we buy it. And that gives, often the numbers are dressed up and there's sometimes you find a business hasn't been invested in like it should have been, so they just try to make earnings look as good as they can to get the best price when they float, and then all of a sudden you're wondering why there's these profit downgrades over the next 2 or 3 years. So that's the first thing. The second thing is the stuff that this business sells actually sounds like exactly the sort of stuff that we want a business to be selling. It's stuff that you have to, it's repeat purchases, it's fairly low cost. And I don't, you know, everyone knows Libra, the brand, so obviously that's been invested in, that's great. The one thing I'd watch out for with this business is we saw Procter & Gamble in the US, Warren Buffett used to have a big stake in it, and one of the reasons he doesn't anymore is because this business lost its pricing power. So before the GFC, we were actually quite happy to pay for the best loo paper, and these days we're not. We're actually much more conscious about our budget. So I don't know what sort of price assortment goes for, but it's actually something you can keep an eye on in the supermarket and see what other competitors are out there, because it's not today's earnings that you want to worry about, it's where they are in 5 or 10 years, and the sorts of things that sustain big share price runs are companies with pricing power.
Okay, and I guess that's the big thing, the supermarket wars. I mean, Sorbent would rely on being stocked in supermarkets, as with the Libra brand and any of the other products as well. So a lot of it has to do with the supermarkets.
Absolutely, Julia. And I can tell you, any business that you speak to that needs to supply through Woolworths or Coles will tell you it is really, really hard going. They're almost forced to offer incredible sort of prices regularly. They're charged incredible fees to be at the right point in the aisles, or their competitor will be put there. And from what I've remember, I'm trying to think, I'm pretty sure they don't have home brands in this sort of area yet, but they probably will at some stage, and then pressure gets applied further. So, I mean, I've always, just the companies that we meet and talk to and the anecdotal evidence you hear is, I've always been wary of it. I think some do well, and we were talking about Bellamy's, and I looked at Bellamy's because, you know, we've got a new daughter and we were feeding her that, and from what I saw...
And I have a new daughter, so I was feeding her organic foods, and I looked at the company.
and a lot of mums are sort of doing it. But the one thing that put me off was the Woolworths Coles sort of factor, because that's really the only place you can sort of purchase it. But they've clearly been able to, as Nathan was saying there, they've been able to hold their prices from what I've seen. It's never on sale, and it's always the same price.
And the difference is the potential upside from exporting to China.
Absolutely, and they're starting to roll out a whole lot of new products. And I think this is what this business will need to be able to do, is it's not going to be able to keep growing its earnings by selling toilet paper. I would have thought that's a mature industry, and it's going to become more and more and more competitive and price competitive. So they need to find ways to utilise their assets to roll out new products that they can leverage off those brands, and that comes down to management, execution, those sort of things.
Okay. I would hate to see what the private label loo paper looks like if the 85-cent slices of bread are anything to go by. Terrible.
Okay, so that's AHY. It has been on the market for around about 8 months now, and the share price has been a little bit of a rollercoaster ride, but after the results, doing well. It's managed to beat its prospectus forecast, and it looks like well supported at these levels, but supplying the supermarkets always quite difficult. Let's go to our next caller. We've got Catherine on the line from WA. Catherine, welcome to the show. What's your question tonight?
Oh, thank you for the show. It's my favourite.
Oh, thanks, Catherine.
I would like to ask about the marrying of the telecommunications Amcom and Vocus. We own 5,000 Amcom, and we're wondering whether to sell before they join up, because we'll lose half our shares. We'll only have 2,500 left.
Sure. Love how Catherine put that. The marriage of Amcom and Vocus. Should she keep her Amcom shares, or should she sell up? What do you think, Ben?
Well, you certainly wouldn't sell for the reason that you've just given there, Catherine, because yes, you're going to have half the number of shares, but you're going to have it in twice a big company. So that isn't a factor, so don't worry about that. More what you're interested in is what's the outlook for the combined company. And, you know, this is another both these stocks actually sort of had fairly disappointing earnings results during the season. They didn't deliver on expectations. You sort of see a bit of a pullback in the share prices there. I think and there is still a bit of uncertainty with TPG sort of waiting in the wings, but I think the merger will go through. I listened to the joint sort of presentation when they announced the merger. I thought it made a lot of sense in terms of what they're doing, and my sort of inclination would be to stick with it. I think they're both good businesses, but you know, I think there might be a bit of short-term weakness in the share prices, because often you see businesses that under-deliver, trading on high earnings multiples, will underperform for a period of time. But I think, and it's going to take some time for, called the marriage there, it's going to take some time for the benefits of that to flow through to accounts. Probably, you know, 18 months from where we are now.
Okay, so it's going to take a little bit of time. Nathan, what do you think? Would you be holding on, or would you be...
Yeah, I don't have much to add. Unfortunately, one of my analysts wanted to put a buy on this at about $1.70, and I think the stock's tripled or nearly quadrupled since then. So we got that one wrong. Again, I think it just shows that this sector is almost getting towards the end of the amount of companies that can be consolidated. So it's not that that's good or bad in this case. I don't know the details. But just keep that in mind, that if you own companies in this sector, be careful of whatever acquisitions get done from here on in, because I just don't think they're going to produce the sort of value that the ones in the past have.
Okay, so a little bit of caution in this space. Let's now go to an email. We have one here from Ian, and Ian writes, could I get a quick appraisal of Dick Smith in particular and retail in general, please? Dick Smith's an interesting one because it looks like sales has been doing okay. Total January sales rising 17% and another double-digit increase in February so far. But Macquarie is saying that they're worried about the inventories. Inventories have risen by $81 million from the end of June. Nathan, what do you think of Dick Smith and retailers at the moment?
Retailers, for me personally, I just steer dead clear. I've lost enough money in that sector over the years. I don't need to lose any more. It's just such, like any retail stock I look at, you can make a case that it's blindingly cheap, but then all of a sudden there's these big profit downgrades, and because the space is just so competitive, and if ever anyone's going to make money out of this sector over the long term, it's probably more likely to be someone like Westfield. So I don't know the details of Dick Smith. I saw it floated a while back and basically lost interest. We've recommended the Reject Shop. The share price has fallen a bit since we upgraded, and again we've gone cold on that business as well. So for us, retail stocks are just too hard.
Okay, so no retail for Nathan. Ben, how about you?
I see retail stocks more as trading sort of opportunities generally, and I totally agree with what Nathan said there. I mean, I think the thing you've got to realise, like, you look in the US, there's these big retailers, right, listed on their market, but our country is so small and our population centres are so tight. There's only, you know, even in Sydney, there's only so many stores, even if you've got a great concept and it's successful, that you can roll out before you start to cannibalise yourself. And, you know, I think electronics generally is super competitive. Dick Smith I would be steering clear of. We are in a couple of retailers, but maybe we could talk about them after the break if you're winding me up there, Julia.
It's actually the end of the show, so we'll have to wait till you come back. No, that's all we have time for today. Thanks so much to our guests, Ben Clark from TMS Capital and Nathan Bell from Intelligent Investor, and to you, our viewers, for all your calls and your emails tonight. Till next week, I'm Julia Lee from Bell Direct. Have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is